Hello again and welcome. This is Robert Schein, Managing Director and Partner of Blanke Schein Wealth Management. Thanks again for joining us. It's February 11th, 2022. It's a Friday Insights edition. We're going to tackle the CPI, the data, the Fed, and a whole lot more. Thanks for watching. So here we go. The volatility continues. What started in January, both stock and bond markets sold off. Interest rates rose in anticipation of what the Fed might or might not do. They're going to raise rates. We know that the Federal Reserve is behind the yield curve. In fact, yesterday we got the CPI data and it showed 7.5% for the month of January, and it's a 40-year high right now on the CPI. It was a super hot inflation read. It meant that everything's coming down, stocks are coming down, bonds are coming down. No really safe place to hide, if you will, because yields are going up globally, both here in the U.S. and around the world. And essentially, it's the Federal Reserve. A Federal Reserve President Bullard came out and said that we need supersized rate hikes going forward. And there's a lot of speculation whether it's 4, 5, 6, 7, 8, 9, 10. No one really knows. We only know when the Fed will do it. Now, I was in Fox Business yesterday morning, early, and we discussed this before the CPI report. And essentially, my take-home point was the Federal Reserve's got to move because they're behind the curve. We see inflation everywhere. You and I are feeling it at the pump, grocery store. Companies are feeling it. They're feeling it in the COGS, cost of goods sold. So labor prices are going up. The input costs are going up because of the supply chain issues. We have a lot of just inputs, and a lot of those companies are able to pass it on to the end consumer for now. But as interest rates continue to rise, that's going to slow down this economy. Economy's strong. Corporations are earning money, but 2/3 of the S&P that reported said that their concerns are higher input costs, i.e. labor, supply chain constraints, so on and so forth. So how do we do this? Well, we look at history in the past. In the early 80s, again, we had 40-year-old readings right now like we did back in the early 80s, but we had super high inflation back then, 21.5 prime interest rate. Paul Volcker was a Federal Reserve chairman at the time, and he had to break the back of inflation by doing supersized rate hikes, if you will. Now, we're not in that space. One of the reasons why is because we advent of technology. Technology will help us, and ultimately, like if you look at the read yesterday from the CPI and the data within it, like one of the calculations in there and the inputs for the CPI data read was 40% year over year on used car prices. Economics 101, the cure for higher prices are higher prices. We're seeing that in real estate. We can see real estate cool off a little bit as mortgage affordability comes down, mortgage rates go up, and essentially what people will be chasing, and that'll increase the supply. The equilibrium everywhere has to start equaling out. Now, we believe that the CPI data will roll over, meaning we won't be 7.5% as we're seeing. We could be maybe one more month, but we could see that roll off simply because it's a rolling average month over month. So statistically and practically, we're going to see that number temper as we get through later this year. So that being said, there's still a lot of inputs that matter, right? We want to look at commodity costs, oils, the gases, even some copper slowing down and coming off, because gas right now is $1 more than it has been year over year. It's a substantial increase and a big impact to the consumer. That's the real take home. Now, on the other side, how we're investing as investors, how we're investing positioning. History has shown us that you can still and actually make a lot of money when interest rates are rising. Back in the late 80s they got through it, early 80s, 80 to 82. Markets traded sideways, but it set the market up for a 2-decade expansion once inflation was actually under control, and a lot of policy changes, Reaganomics. We saw the same thing happen in '94. Federal Reserve tried to raise interest rates way too fast. You had Congress all in one side, if you will. Basically it was the Democrat-controlled Congress back then, and you had Newt Gingrich come in with a red wave, and they stopped sort of the policies of spending, overspending. I think that's one of the reasons why in '94 you had the double whammy. You had interest rates rising too fast, and you had too much spending from Washington. And it happens on both sides, both red and blue. They spend too much. We could see this happen later on as we get closer to midterms. If you watch my market outlook and opportunities earlier this year, we have a base case that we said, listen, we're going to be choppy for this year, all the way through to midsummer, early fall. Why? Historically speaking, we had 9 data points that showed the markets will sell off in January, as we've done. We're sort of work our way back through the year, but grind our way sort of in a trading range That's why you want to pick your spots, not by the index. You want to buy individual companies that can outperform. We're seeing names that are outperforming even year to date relative to performance of the indices. And that's still going to be good, and that thesis will still work this year. Now, as we work our way towards the back end of this year, we'll know more. We'll know how much the Fed has raised. We'll know how the market has processed it, how the economy has absorbed it. Will there be an equilibrium of the imbalance of spending? Think about this. In the last 2 years, we've had a spending imbalance, which that means too many goods have been consumed or been purchased and not enough services. So goods and services, right? We couldn't go out to, let's say, the concert, the movie theater, or so on and so forth, right? Any sporting event, because of their, or the services, like to a restaurant. That just didn't exist. It wasn't happening. Now we're going to see moderation. That's going to be spending our dollars going this way. And so the goods and services we don't need. So, once you buy a TV or a washer or dryer, you're not going to need one for quite some time. And that's when we were home, we were all purchasing goods. Now we're going to have that wallet shift, that wallet share to services. And that'll help temper the inflationary pressures that we're seeing. That's what the Fed's hoping, and that's what we need. Because the Fed can't do it all by itself, right? We have $2.35 trillion of global liquidity by our Federal Reserve and global central banks being sucked out of the market right now. So it's not unheard of or unexpected to see some growing pains that we're seeing right now. The markets are really getting through what's happening right now. They had 2 years, actually probably a decade of QE, quantitative easing, and now we're going to quantitative tightening. So yes, choppiness, sideways market, still opportunities on a go-forward basis, but that's what's happening. And the Federal Reserve has to take the 7.5% CPI, which is a 40-year high, down to 2%. That's their target. And again, they can't do it all by themselves, but we want to follow and watch those companies that have the ability to pricing power. They'll raise their prices and the end consumer will absorb them. There are plenty of companies out there. We're sifting through all of the available options, and you'll see them work our way into how we navigate our portfolios for our clients. So there's always a bull market somewhere. Now, the volatility is there. We don't like it. Market, present, our statements coming down from time to time. One thing we do know, it doesn't persist permanently, right? So that's why we're in it. We were looking for a long view. Markets are adjusting. Once market adjusts, and there's sort of finding its equilibrium and its sort of its balance. In the meantime, we're putting a lot of capital to work, and we're going to look back and say, you know what, we did. We were happy with not only what we own, why we own it, which is our thesis, but also the timing of which we can never predict the timing if it's right or wrong. But I tell you, when stuff's on sale, it's usually, historically speaking, been a good opportunity. So that's where we are right now. That's our Friday Insights. Hey, Super Bowl this weekend. Either which way, we don't know. We'll see how it goes. I just want a good game. It should be fabulous, and it should be great to see, again, life out there once again in America. So hopefully you find your favorite Super Bowl commercial, and we'll talk about it on Monday. Have a good weekend. Take care.